Everybody's watching closely to what happens with the Federal Reserve and the central banks. Why? Because every word that they share is literally affecting what's happening within the markets, within the economy, your individual bills, and everything in between. Today, I'm going to show you exactly what's going to happen at the Fed meeting, the two different possibilities, and what that means for you. If you find it valuable, consider subscribing because you're going to get the information first before you get it out there and it gets disseminated in many places. This is what we need to begin with. If we don't connect all the puzzle pieces, we are simply skimming over the data. More Americans than ever can't afford to pay their electric bill. How insane is it that we have had trillions of dollars that had been printed, and yet the average person is having trouble paying their electricity, their food, their shelter? These three basic things should not be expensive. It should be reasonable, and yet it's anything of the sort. With more people owing more money, utility companies are getting more aggressive about shutoffs. And this is what I talked about in the previous video to this one. So those subscribers here on the channel already know about this, but it is truly extreme, to say the least, in how many people, 20 million people in the United States alone, can't pay the bills. This extends out into the UK. And we will discuss that as well in today's video. What I wanted to show you here was related to the Federal Reserve. I'm going to show you the data as it stands. And what we have here is that the Federal Reserve has these different meetings that come up, whether it's an FOMC meeting, and that, of course, is where they decide policy. Are we going to raise interest rates? Are we going to print some money? And so on. And then they have Jackson Hole, which is basically an event that all central bankers may attend. And we're going to get some interesting info because that's usually when big decisions are made, if, just unofficially. So we've got this coming up. And for those who are paying attention, we are going to see two potential pathways. We'll get into that more in a moment. Fed officials push for more hikes. Bullard favors front loading, something that's been going on for a little while, in fact. Officials gathering in Jackson Hole for the annual policy retreat. George says that rates are still not high enough to break the economy. You got to know this because each of the individual voting members are going to have a different opinion, and then we see where the consensus lies. But this is Bullard. I like the front loading. I like the idea that you get the rate increases in earlier rather than later. So let's go hard now, and then we can watch inflation go down. We go a little bit softer and softer instead of trying to do this little tedious back and forth in the markets. Where are we going? Where are we going? If we just go hard right now, then, and by the way, hard as in their definition, and then you could see what happens. But they're going to balance that, right? I believe personally September's meeting will probably be a 50 basis point rate hike. And so we'll see. You show you are serious about inflation fighting and you want to get up to that level and you put downward pressure on inflation. We are at 2.33% right now. That is not high enough. And they're talking about the Fed funds rate. They want to get that higher because you've got inflation at over 8% on their official metrics. So you want to get that down. How are you going to do that with 2.33% inflation? It's not going to happen, right? And they know this. They're not being silly about it. They just, play this cat and mouse game. So you could see Esther George, quote, "It's very important that we are clear in our communication about the destination we are headed. We have to get interest rates higher to slow down demand and bring inflation back to our target." So they have made this message that they've been sharing all along prior to Jackson Hole. And so I'll just get through the main point that I believe is crucial to understand, okay? I wrote this down because there's two things that we need to go through, and then I'll show you the details following that. Don't leave me now after I give you this, because you can see that the Fed, during this period of time, has been saying all of these things. Okay, we need to get inflation down. We need to get inflation down. At this meeting right now, or I should say leading up into it, the markets have started to rise because the belief is that the Federal Reserve is going to start to decrease interest rates in a very short period of time. There has been no possible, way that they've gotten that actual literally, because I look at literally every single message coming out of the Fed, and there has been nothing of the sort. But that's the belief. So if the Fed is neutral, not even dovish, not even, yeah, we're going to cut interest rates tomorrow. If they're just neutral on their forward guidance on tightening, and forward guidance is basically just the words that they use. On tightening, this will be seen as dovish and the markets will rally. If the Fed reiterates over and over the need to stop inflation, markets will suffer. Okay? Those are the two things. This is very clear. Remember, if they're just neutral, if they're, yeah, we want to stop inflation, but we also don't want to have any impact, and we're watching the data closely and this and that. If they go there, markets are going to love it. If they just keep putting out these messages that we're going to be tough, we're going to get inflation down, all this stuff, well, then the markets will not like that. The serious situation today is that likely inflation, even if it continues to fall downward, you look at where we are today, you look at where it's going to be by December, based on the trajectory it's heading right now, it's still going to be very elevated. Like by any metric you use, let's say 5 to 6%. 5 to 6% inflation, after having very little inflation on their metrics for such a long period of time, that is significant. Remember, it's year over year. It's not what do you currently pay for something. No, these are year over year stats. So 5%, 6%, that's still significant. So you look at all of this and have to start to think about what could happen as a result. Well, of course, they bring inflation down, according to them anyway, they bring inflation down to 5 or 6%. They still have to keep interest rates elevated to a degree for a period of time in order to get that back down to their 2% goal. So I hope people understand that. Okay, I don't want to just harp on about it, but that's the real situation. And you've got Bridgewater's Jensen. Okay, so he's the CIO, and he sees stocks and bonds dropping up to 25% on the Fed's quantitative tightening. In September, a lot of people point out, they're not doing any tightening and this and that. In September, that's when the acceleration of QT happens. So we will see them. We'll judge it then. Assets are not pricing hits from the Fed's tightening and rate hikes. Quote, unfortunately, the inflation will be more stubborn. Of course, like I said, into December, if we're still seeing inflation at that 5 to 6% range, it is still significant. When you look at that, it's a year over year stat. Okay. But who's winning during this period of time? We've got inflation and people cannot pay the bills, as I showed you in the beginning, and I'll show you more in a moment here. Who stands the gain? Well, check this out. Companies at the center of the global grain trade have enjoyed a record bonanza amid soaring food prices around the world, raising concerns of profiteering and speculation in the global food markets that could put staples beyond the reach of the poorest and prompting calls for a windfall tax. So, of course, you've got the big four grain traders. They're dominating the markets and they are making extreme levels of profit right now. But they're not the only one. Check this out. I'll show you that in a second. Look at this. We're talking about the financial conditions because you see who's winning, but what's happening underneath the hood? Well, during the period here, can you believe it? Financial conditions index. Okay, this is showing us globally. It's just, a metric that you can look at. But anyway, tighter financial conditions, the higher it goes. So we saw, unbelievably, financial conditions are less tight now than they were when the Fed started to hike interest rates. It makes no sense. The markets make no sense. All of the details that they are outputting to us right now do not make sense. We need to be clear about that. You have this, it's just showing us specifically the US financial conditions. Financial conditions are looser than prior to March's liftoff. I need to stress how odd this is. Now, we do have something that we need to keep an eye on, and that is the Fed's balance sheet. Because you can see this as a total number, that's something, but also look at it in the delta, the change in between, the year over year change. And it's going to be significant because when you have extreme growth, 2020, balance sheet increases by trillions and trillions of dollars. That is going to boost assets. The riskiest assets benefit the most. And then when the balance sheet increases, but not by as much, it's more of the stable and secure assets. And then when it goes in the opposite direction, and the more it does so, it will have the reverse effect. Now, could they stop their quantitative tightening and just simply say, no, we're not going to do that anymore? Of course, it's possible. But it would make no sense. Of course, they need to provide themselves with a buffer zone in their interest rates in particular. That's so key. If they don't give themselves that buffer zone, you have another crisis. You can't bring interest rates down to have a stimulative effect. They realized that in 2020. That's why they had to print so many trillions of dollars, because interest rates were already so low. So what's going on here? Okay, I got a couple more minutes to show you what we see, and that is, according to the EDF, more than half of UK households will be in fuel poverty in January. More than 10% of a household's disposable income is forecast to be spent on energy. That's not food, that's not shelter. We're talking about just the energy bills. What do you think that does to the economy? You see what I'm saying here? I'm connecting all these dots, and I really appreciate you being here all the way at this point into the video. What about this? Nord Stream 2 is the only solution to the situation with gas in Germany, Bundestag deputy believes. So you've got people in the government basically saying, we have to get Nord Stream 2 online. I've mentioned this before, but it was literally within less than 2 weeks, I think, that the Nord Stream 2 pipeline was canceled or suspended, let's say, and the Ukraine situation happened. I'm not saying that's because of that, but look at what's gone on since. I mean, it's crazy. You rely on the country to pump out the gas. You've put so much energy and attention into it, and then what happens? Look, you've got serious problems. You got geopolitical problems. That's one thing. But look at what's happening to the people. They are reliant on the gas coming in, assuming that it's going to be roughly the price that they paid for it, yesterday, the day before, and so on. But it isn't that case. We've got this. Blackstone single-family landlord to halt home purchases in 38 cities. So as you know, if you've been watching this channel, Blackstone, BlackRock, all these different major big businesses, mega businesses, they've been buying up not just the multifamily residences, but they've been buying up the single family homes. And the expectation is that in the near future, 40% of the single family homes will be owned by one of these big corporations. And now, interestingly, they've stopped. At least Blackstone has stopped. What's going on? Well, apparently, they believe that the market is not, a buyer's market. Okay, they do not want to. Let me say that again. They do not believe that now is the right time to buy. Okay, let me say it like that, because borrowing costs are higher. Home prices could potentially fall because usually it's stock market first, then home prices next. So look at your particular area and watch it carefully. Okay. That's it for this video. I just wanted to show you all those things because you can see interest rates and the way they impact homes. You could look at what happens with inflationary policies and geopolitical events and supply chain factors, and look at what that does to the prices that you pay for your energy and all these other things. All of these add up and they ultimately put pressure on individuals. I've gotten so many different comments about this globally from people. You've got to share what's happening around you. This is so important. This is a grassroots channel and I appreciate you being here. There will be more on this information. You've got to subscribe and I'll see you on the next one.